Students, welcome back. This is video 2 where I'm going to be covering bonds. So we talked about earlier the capital structure of a company, meaning how they finance themselves, is made up of a lot of different things. They can have short-term notes payable, they can have leases, they can have long-term installment notes, which we just finished talking about, or they could have these things called bonds. Now, bonds are really unique in the sense that it's large companies that tend to have them. And the reason companies get bonds is normally they need large amounts of money, and it's too much money for one bank to lend to them because banks have lending limits, how much they can lend to individual companies. And so companies go out and they do these bond issuances. Bonds are like stock in the sense that they're traded on exchanges. So just like you could go out and buy a share of Amazon on the stock exchange, you could also go out and invest in a bond in Amazon. And so because it's publicly traded, bonds tend to be very expensive to take to the public because you've got to pay lawyers, you have to pay investment bankers, and you have to get it listed on an exchange. So bonds tend to take a while to get in place, and they're very expensive. But the benefit is that they're big dollars and they're extraordinarily long term. So, for example, before I started this lecture, I looked up Amazon. Right? So Amazon, inside their long-term debt section, they have $9.7 billion in leases. That's how they finance part of their portfolio. They've got $23.5 billion in long-term debt or bonds. And those bonds mature as late as 2057. So a company might do a bond because they want to borrow money for a much longer period of time. It's much larger than an amount a bank might give them, and it makes it much easier after they actually get it up and running. That can be expensive. So when we talked about the installment notes in the earlier lecture, every month we were paying, right? We were paying a little bit of interest and a little bit of principal. With bonds, we're going to do something completely different, right? Because we like to make this as hard as possible. With bonds, we're going to borrow the money day one. Way off into the future, we're going to pay the principal back. But in between that, probably every 6 months, we're going to pay interest, right? So it's just interest. So think of it this way. I want you to think of it for a second as you're the investor, not the company, right? You go out, you purchase some Amazon bonds. Let's just say you purchase $10,000 in bonds at 5% interest. Amazon's going to pay you 5% interest in 6-month intervals over the whole life of that bond, right? And at the end, they'll pay you back the $10,000. Right? So that's different than anything we've seen before. Okay, so let's keep going through it. Let's talk about a couple of the different types of bonds that can be out there. And honestly, this list could be 100 lines long, but I picked the most pertinent to show you. A secured bond means that it's backed by collateral. What is collateral? It's something that if the company goes bankrupt, we as the investor can take, right? So for example, a lot of bonds that banks issued are the collateral that the banks put up for those bonds are their loan portfolio, right? That says, hey, if they stop paying, then people can go after those underlying assets. An unsecured bond means there's no collateral. Okay, if you're an investor, which would you rather invest in? Well, it depends. Unsecured is probably going to have a higher interest rate, right? Because it's riskier. Whereas the secured is going to have a lower interest rate because it's less risky, but it's going to be more secure. So it really depends on your appetite as an investor. A term bond, the issue matures on a single date, and that's what we're going to be focused on, our term bonds. Serial bonds, they mature in installments. So again, a little bit of the principal comes back in some sort of interval. We're not going to cover those. Callable means the borrower can pay off the bonds early. All right, so why might you want a callable bond? Well, let's just say you needed to borrow money and interest rates were extraordinarily high, but you needed this money for 20 years, but you're really hoping interest rates go down. You might make that bond callable, meaning that 5 years, 10 years in the future, you can call those bonds or redeem them and then go off and issue bonds at an interest rate that appeals to you more. And then lastly, we have convertible bonds. Sometimes the lender, right, that's you and me, people going out and investing in them, we can choose to convert our bonds into common stock, right? So what are we going to focus on in this chapter? We're going to just focus on term bonds. We won't care about secured, unsecured. That doesn't change the accounting. It's really just more something the investor is interested in. Okay, as I said in the earlier chapters, we are not going to deal with pricing of bonds. I'm going to leave that to Professor Banerjee to teach you, and that's about time value of money and present value, not something we're going to talk about in this class. All right, but what I am going to talk about is probably the most important concept for you to understand the accounting for bonds, right? So if you're watching Tiger King while you're listening to this, I mean, first, kudos to you that you can listen to two things at the same time. Second, Tiger King is awesome and keeping us all, I think, going through this crazy time. Spoiler alert, if you haven't seen it, they're all crazy, which is what makes it so good. Okay, but tune into this for a second. So, bond accounting would be so simple. We would just record all of the payments, record the interest every time we made a payment, and just drive on and be on our happy, merry way. But we've got these things called premiums and discounts that add a layer of complexity. To understand the accounting for them, you need to understand why they exist, why we have premiums and discounts. I want you to listen to this, then listen to me talk about the accounting. Come back then and listen to this again after you've done some of the accounting to see if it makes more sense. Okay, so I talked about that when companies decide to issue bonds, they have to go out and go through a process with lawyers, with investment bankers, etc. So there is a gap in time between when a company says, hey, we want bonds, right? We want bonds. And so they put all their materials together and then they wait for it to get filed. And then the bond gets priced and goes live. All right, so between those two times, interest rates change, right? We would love to say interest rates stay the same. They really don't. Interest rates change in a bond market every day because the things that influence interest rates could be what our Federal Reserve is doing, what the stock market is doing, what the economy is doing, really the company itself, how people are viewing the company. But the moral of the story is whatever rate that I put on my bond offering on this day, right, it's probably not going to be the actual rate that people are willing to accept once I get to my date to sell the bonds. So what do? I can't reprint and refile all the materials. We just don't have the infrastructure in our system to be able to do that. So instead, I account for the fact that interest rates either went up or went down by changing how much cash I'm willing to accept from the investors. All right, so let me just try to give this to you an example. I decide I need to borrow $10 million, right? And I say that $10 million I'm going to print on my papers 5%. That's this date right here, right? So I've got $10 million at 5%. Well, a little bit of time passes. I finally have all the things that I need to be able to sell the bonds, but the interest rate that investors are willing to accept on that day is 6% because some factors changed between the dates. Well, I can't reprint that 5% that's on all my papers. So what do I have to do instead? I have to say, okay, if you're willing to give me the money, I will still pay you a 5% coupon, meaning those semi-annual payments, but I'll take less money. I'll take I'm going to make this up because I'm not doing a present value calculation. I'm willing to take $9.8 million. That discount in the bond price is what gives the investor the equivalent of 6%, because the investor's going to give me $9.8 million. I'm going to pay them 5% over the life of the loan, life of the bond. And then when the bond matures, I'm going to pay them back 10 million, right? They got a bargain, right? That's how that difference between the cash that I'm willing to accept versus payback at the end is how I make up for that difference in the interest rate. Now, the same thing can happen. Let's just say interest rates go up. Well, now, since interest rates have gone up, right, who's going to be willing to accept this? So now we've got to change how much people are willing to pay. Right, make sure I said this right. Right, so we don't want to pay. Oh, I totally said this wrong. This is where I always get it mixed up. Bonds that are issued at a premium, right? So this is where I'm just got to read my own notes for a second, because I tell you what, make good notes on this premium and discount, because it's easy to get them flipped around, right? So in this case, I get to issue, let's see here, pay more interest, right? So I had that a little bit wrong. When the interest rate goes higher, no, I didn't, I had it right. Okay, sorry for that. So now the interest rates have dropped, right? So before, the interest rates had risen, so we had to offer a discount. Now interest rates have dropped. Well, heck no, am I, the company, willing to pay 5% when I can go out and get it for 4%? And so what I say to the investors hey, you got to pay me a little bit more. So instead of paying me the 10 million, maybe they're paying me 10.5 million over time. And then at the end, I pay them back the 10. That ends up with a premium. So again, why in the world do we have to deal with this? Because we have a gap between the time that I print my materials and the time they come in. Those gaps in time create differences in interest rate. When my stated rate is greater than my market rate, I issue the bonds at a premium. When my stated rate is lower than the market rate, I issue them at a discount. And those premiums or discounts are what gives us the bugaboo in accounting. Okay, so again, I'm not going to ask you to price these using present value. I want to focus on the accounting instead. So we get to that slide. I'm afraid to click through these too fast because goodness only knows what I would do to my iPad's PowerPoint. Okay, let's get this. All right, so let's get to the recording part. Now remember, we just looked at this slide earlier. This is a really useful slide for you to have, right? To remember whether bonds are at face, they're at premiums, or at the discounts. So let's just issue it at face. Let's just pretend in a perfect world, the day that we went to market, the interest rates were the same as what we printed, right? We're going to debit cash. We're going to credit bonds payable. Where does bonds payable sit? It sits in our long-term liabilities. Okay, now, bonds, remember, we only pay the principal, right? So we borrow the money here. Long time passes, we pay the money back here. So we borrow the 100,000 day one, we pay the 100,000 back. That's different than those installment notes, but we're going to pay interest every 6 months. Okay, so biggest mistake I see students make is they forget that this is semi-annual, right? Meaning 6 months, not a year, not 1 month, 6 months. So you need to decide, you need to look at the date it was issued and the date that your first payment is made, and see how many months have passed and whether or not you had to do an accrual over a year end. But let's just, here we've just got a January 1st issuance, we've got a June 30 payment. So our interest expense is going to be 100,000 times the 7%, because remember that's always annual. Here they just divide it by half, right? You know me, I would divide it by 12, multiply it by 6, because I like that, and credit cash. Okay, so you're the bond holder, Yay, you're getting cash, right? You bought a bond, you're getting your interest expense. Nowhere on here is principal. Okay, so take a moment. I want you to do one that was issued at par. We'll come back and look at it together. All right, we've got 700,000 of 5% bonds due in 10 years with interest payable annually. Ooh, it's annually, not semi-annually there. So key into that. Always make sure you understand. And the market rate, yay, is 5%, which is the same as our issue. We don't have to deal with premiums and discounts, which is a winner. Okay, we issue the bond, we get cash, we credit bond payable. We're at the end of the first year. Well, the nice thing here is our payment date is the same date we would normally need to accrue something. So how much do we owe people in interest? Well, it was 12 months of interest, so it was 700,000 times 5%. You could, if you want to take that out, say divide it by 12 times 12, but right, that's kind of silly. It's just a year. 35,000. And we're going to keep doing that $35,000 entry every year at the end of the year until the bonds mature. Easy peasy. All right, let's get to the more complex piece. Recording bonds payable issued at a discount. So remember, this is where we issue 100,000 of bonds paying 7% interest. Okay, that's our stated, right? So 7% is our stated. But what happened to interest rates before we could issue them? They went up. Well, think about it. No investor in the world is going to buy a bond at 7% if they can go out and earn 8% someplace else. I have to entice them to buy my bond. I do it by selling that bond at a discount. So basically what they're getting is they're getting a bond worth $100,000 and they're only paying $93,205. Even though the interest payment we'll make to them when we make our coupon payments is still at 7%, we're getting them that extra 1% by taking less money for our bond. Okay, so journal entry we do day one. Debit cash $93,205, right? Nobody gave us the $100,000, but look, we still have a liability of $100,000. That's how much we're going to pay them back. It's not their fault that they were willing to take a little less money. We balance that entry by recording a discount on bonds payable. Where does that sit on the balance sheet? It is a contra liability that sits with bonds payable. So that if you looked on the balance sheet, you would see $100,000 in bonds, and then you would see that contra of 6,795, right? So that your net bonds would be 93,205. If you think about, because we have to pay the bond holders back $100,000 at the end, think about what I'm going to do with this discount over time. I'm going to get it to zero, right? So that I show a liability of a full $100,000 at the end of the bond. And here's a nice, prettier picture than the one I drew above of the way we're showing this on the balance sheet. Okay, so now it's time to actually make the payment. And this is where things get a little tricky. Let me walk you through it. Cash never changes, okay? Cash never changes. I'm going to say it again. I have $100,000 in bonds. That 7% is the stated rate, right? Because they're only entitled to what legally was printed and to dividing it in half because it's a semi-annual payment. My interest expense, however, is going to be the $93,205, right? Which if we look at that previous picture, oops. That's how much we had on our balance sheet, right? Day one. Times the market rate. Okay, biggest takeaway there. My coupon is always stated. My interest expense is always market. All right, now your journal entry won't balance. You've got more interest expense than you do cash. So we're going to balance the entry by decreasing that discount. Because remember, the discount that we recorded previously, and I don't remember the exact amount, which was roughly like maybe 7,000-ish. Now I'm going to start decreasing it, right, with this credit. So that discount is slowly going to lower to zero over time. Second payment, same thing. My cash doesn't change. My interest expense, right, now I've got an updated balance, net book value of that debt, because I changed it by the $228, times the market, divided by 2. And I'm going to balance it with 237. So again, now I'm slowly changing that note payable by decreasing the discount. If we looked at that in an amortization schedule, we would see 93,205 is what my net book value was day one. That's the cash they gave me, right? And I'm slowly decreasing, I'm decreasing the discount, which is increasing the balance. So see how it's going from 93,205 to 93,433. Eventually, when I pay that back, I will have changed that discount to zero, leaving me with the $100,000 in debt. Cash never changes. Interest expense is based on the market rate. The cash is always based on the stated rate, and the difference between the two impacts the discount. Okay, premiums. If you can understand discounts, premiums are exactly the same. It's just the situation is flipped. So with a premium, I printed my bonds and I said, I'll give everybody 7% coupon. Well, interest rates dropped to 6%. Well, if I'm a bond buyer, woohoo, I want those 7% bonds. The only problem is company's not going to sell them to me now. There's no reason they should pay 7% when instead 6% is the current market rate. So what they say is, hey, you know what? I'll pay you the 7% coupon, but to make up for that 1% difference, you have to give me a little more cash day one, right? So that little bit more cash, we can see here, somebody has to give me $107,439 instead of just the $100,000, and that represents the premium. What do you think we're going to do with this premium over time? Well, we're going to get it to zero, so when the bonds mature, we only have the $100,000 on our financial statements. So this time I'm going to, since I remembered the 7439, right? So premium 7439. I'm going to put my premium T account. So first annual payment, cash is always the same. Cash is always stated. But my interest expense is market. The difference between the two is a decrease to the premium, right? 277. What happens when I decrease the premium? Well, now I'm slowly decreasing that bond value. Because remember, if we look on that previous page, dang it, right? Today, a premium is increasing the face up. If this were a discount, it would be decreasing it. All right, let's look at the second payment. Cash again, unchanged based on the stated. Interest expense based on the market. And what do I use for my base? Well, instead of the 107,439, because I had a premium of 7,439, my premium is $277 less, so that's why I'm using it in that second month. And again, it'll keep going, and you'll see that in this amortization table. Right, so cash is always the same. Interest expense is always based on that previous carrying value, right? And if we make the adjustments to the premium, that in turn adjusts the carrying value, so that at the end, we end up at $100,000. Regardless of whether I have a premium or a discount, at the maturity date, I'll be back to the initial amount that was stamped on my bond, because that's what I'm doing. I'm amortizing that discount to zero. I'm amortizing that premium to zero. All right, so I want you guys to try to do this problem and then come back and we'll do it together. All right, so now we've got a bond. It was issued at a discount. How do I know that? Well, people didn't give me enough cash, right? Think of it as like I had a sale on my bonds. So I only got $619,000 because the market rates went up. Nobody was willing to buy my bonds unless I put them on sale. All right, let's take a look at that. Cash paid for interest is $700,000. Base rate times the stated rate. So $35,000. Looks like I'm paying this annually. The interest expense is the current value of the bonds on my balance sheet, which is the $619,711, day one, times the market rate, market versus stated. I'm at $37,183. I balance my entry by the difference between the two, which is $2,183. All right, stop. Think for a second. Is my carrying value, should it go up or should it go down? Think about where you want to end. You know you want to end at $700,000, right? So my carrying value should go up. And it does to $621,894. Year two, cash paid is the same. To get the interest expense, I'm using the updated $621,894 times the market rate for $37,314. The difference between the two is my increase in carrying value, and I see that go up. If I was going to pull this out the whole way, you would see that we would end our carrying value back at $700,000 because we would have all of those credits, actually all of those debits we make to the discount, no, those are credits, sorry. I always have to think about this, right? Because this is credit to cash, debit to interest expense, balance the entry, I need a credit to the discount. All these credits I'm making to the discount are getting it back to zero. And these are the journal entries. Debit cash, credit bonds payable, credit the discount on bonds. So put a little T account here for discount. So our discount starts at $80,289. When I made that first entry, what did I do? Dang it. I'm going to confuse you guys with this. That 8289 was over here. Right? Now every time I make a journal entry, I decrease it. Exact same thing in year two. Those are coming straight off of the amortization table. Okay, last problem. I want you guys to go ahead, take a moment, try to do this one with a premium, and then we'll look at it together. All right, now we're issuing something at a premium. So premiums increase our total debt. So premiums are going to have credit balances, right? I'm going to get this right and stop confusing you guys. Premium, credit balance. In this case, that credit balance is $59,510. Why do people pay me more? They're willing to pay me more because the market rate dropped to 6%, but they're going to get this nice sweet 7% coupon from me every 6 months, or I think it's every year in this example. So to make up for that 1% extra they get in all those coupon payments, they're willing to pay me more cash day one. So cash paid for interest, this should feel familiar now. That's always the stated rate, right? So the $800,000, 7%, and it looks like it's semi-annual. $28,000. It's not going to change over the life of the bond. Interest expense will. I'm always going to take the book value of the bond, or the carrying value of the bond, times the market rate, and we're dividing it in half because it's semi-annual. We've got $25,785. The difference between the two That's how we balance our entry. And look what happens to our bond. We're slowly lowering that balance so that we can get back to the 800,000. Right? In our T account, we're going to lower that. So this is a credit to cash, a debit to interest expense, and we're going to debit premium. By debiting premium, right, we are lowering the premium, which in turn lowers the overall debt. Same thing in the second payment, which is at the end of the year. Cash is unchanged. I'm using my new updated carrying value, still times the market rate divided by 2, and I'm decreasing my carrying value down to 855. If we look at the journal entries, again, when we first make our journal entry, we get 800,000 bonds payable. People gave me a little bit more because of that change in interest, the 859,510. So I balance the entry with a premium of 59,510. All of the journal entries that I'm going to make are straight off of our amortization table. Debits to interest expense, debits to premium, credits to cash. And the credit to cash never changes, so that should be your anchor point. You always put your credit to cash, then calculate your interest expense, and your change in either premium or discount will always just be the difference between the two. All right, and we're not going to spend a lot of time on bond retirement, but basically what that says is when the bonds are due, I pay people back, right? So if I had 100,000 bonds that retire at maturity, I debit the bond to take it off my books, and I credit cash. If for any reason I retire them before maturity, sometimes I might have to pay a little extra or a little bit less, depending on what current market rates are. I'm always going to take the bond off the financials. I'm going to take any premium or discount off to get those balances to zero. And if it's less, it'll be a loss. All right, that's the end of chapter 9. Again, this is a tough one. Sorry we're not in class to do it together. You may also want to watch the Excel video that I'm about to post that shows how to build an amortization table for bond premiums and discounts, because that's what your project will be. I think it'll also help you understand the premiums and the discounts because, again, it's confusing, and I apologize that I mixed my words up a few times. So, again, good luck, guys. I'm thinking about you. Bye.